My first post this week was about Diamondback Energy, and specifically how Diamondback had negative natural gas sales prices in the third quarter of 2024. I wrote about how the unhedged prices were negative, but actually the hedged prices were positive. And it shows that natural gas, it's been talked about as possibly being a waste product in the Permian. There's a lot of liquids focused Permian operators that aren't really trying to monetize the gas. I mean, it'd be great if you could, but there's real pipeline constraints coming out of the Permian. You can't get all the gas that's being produced to market effectively. And so we're seeing a real pinch for some operators where, in fact, those prices are turning negative and are negative over a full quarter, like we saw with Diamondback. So it's worth paying attention to as these liquid focused operators continue to pursue production there in the Permian, that these constraints in natural gas are real and have implications on the reported financial performance for some of these operators. My next post was about Constellation Energy, the big utility that operates the nation's largest nuclear power generation fleet. And the stock price for Constellation has run up over the past year pretty aggressively as enthusiasm has grown around what the U.S. might be able to do with existing nuclear power assets. And that stock price run up basically has allowed Constellation to put together an offer for Calpine that it otherwise almost certainly would not have been able to put together. I wrote about how smart management teams take advantage of the fact when their stock price starts to boom. Some may issue new shares and collect capital and be able to hold that for future use. Others, like Constellation, are able to use their stock then to go acquire someone. And in this case, it may end up being a transformative acquisition for Constellation. So, an interesting example of what smart M&A activity looks like, particularly based on stock price volatility. My third post, I went back and revisited the Diamondback situation. And in this post, I showed specifically how it used hedges to flip those negative natural gas sales prices into positive territory. Basically, Diamondback did two things. The first thing it did was set a floor beneath the Henry Hub natural gas price in Louisiana. That's the preeminent U.S. natural gas trading marketplace. The second thing they did was set a floor beneath the discount that you get for gas in West Texas relative to gas at the Henry Hub. So I walked through the details of what that two-layer hedge protection scheme looks like for Diamondback, because there's a lot of E&P operators that use similar kinds of schemes to protect themselves in different ways and in different places. My fourth post was about solar power. And I looked back to show how some of the biggest U.S. publicly traded solar power companies took big hits literally on election day, as investors had to rethink what's going to happen to the Inflation Reduction Act and the various incentives that exist around low carbon technologies generally, in this case, solar specifically. And so we saw a big march down of between 10 and 30% for some of these stocks. And these stocks have lived at that level in the past couple months since the election. So I used that dynamic to talk a bit about what the future looks like for these low carbon technologies and why it makes sense that investors need to rethink the valuation for these companies, because so much value accrues through the cash flows that you get in the near term. And if those cash flows are going to be noticeably diminished, then it makes sense that you'd see the kind of stock price move that we're seeing there. My fifth post was about U.S. crude oil inventories. We saw one day earlier this week that U.S. crude prices popped up, and some folks were pointing at inventories and how this week the U.S. EIA reported a larger than expected drop in crude oil inventories. In this post, I zoomed out and I looked at U.S. crude oil inventories. I looked at U.S. inventories of petroleum products, and we saw that over the past 2 years, when you look at all those inventories together, it's almost perfectly flat. The inventories really aren't changing at all. There are other macroeconomic conditions that are changing with time, sanctions and supply disruptions and demand concerns and all that. But here in the U.S., we're not seeing a dramatic shift in the consumption around either crude oil or petroleum products that is moving the needle when it comes to liquids-focused commodities prices. My next post was about BP's layoffs. We heard this week from BP that the company plans to cut 5,000 employees and 3,000 contractors. I wrote about how that's the dark and personal side of this capital discipline story that we're seeing across the oil field. There's an enormous amount of uncertainty that's growing, particularly in the medium to longer term, around global oil demand. And as a result, oil and gas management teams are being very disciplined. They are trying hard not to go chase investments that investors aren't confident are going to yield the kinds of returns that they would need to justify making those investments in the first place. Well, this is part of that story that oil and gas management teams are trying to drive their organizations to be as lean, as small from a headcount perspective as they can get. And unfortunately, BP was the one who announced it this week. And, like I said, there's thousands of people impacted by that. And Unfortunately, given what's happening in the oil field and what we expect about the long-term constraints that exist, this is probably the first of several layoff announcements that we're going to see in the near future. My last post this week was my brand new post at Foundations of Energy. And I wrote about how some E&P operators sell their oil and gas for a lot less than others do. And I went through the mechanics of that in this post. I used a bunch of data. We collected data from 17 publicly traded US E&Ps, some of them gas focused, some liquid focused, some very big, some not as big. And we looked at production mixes and production levels and prices to explain how is it that some operators can sell their oil or their natural gas liquids, their NGLs, or their natural gas for so much more or so much less than their peers do. So this was a chance to really go through all those mechanics and tear through that data. And it's a topic that investors and management teams, of course, are paying a lot of attention to. When we have the kind of uncertainty that we're seeing in oil and gas markets globally, management teams want to be very careful about extracting as much value as they can from the hydrocarbons they're producing today. And of course, that means getting the best pricing that you can get. So it's a topic that's top of mind for a lot of folks in industry. It felt like something that was a good point in time for us to dive very deeply into. That's the pricing side, which of course affects the revenue, the reported revenue that we see from these operators. There's a whole cost side of this story that I'll write about in the future FOE. And it's when you take that pricing and revenue bit, married up with the cost bit, that you get to profitability. At the end of the day, that's what everyone in that sector cares about. Each week, I publish a free weekly newsletter that includes links to and summaries of all the research I post online during the week. That way, you don't have to rely on social media algorithms to surface that stuff for you. I also include an energy related anecdote, insight, or observation that I don't publish anywhere else. That way, even if you've seen everything that I've published online, you'll still have something new to read in the newsletter. In this weekend's newsletter, I wrote about Chinese refinery throughputs and how we saw throughput go down in 2024 relative to 2023. I wrote a bit about the historical significance of that and what it means for the oil market going forward in time. If you haven't signed up to receive that newsletter, I put a link in my profile. I'll also put a link down below. Just click that link, easy to sign up. As always, thanks so much for reading, watching, liking, commenting. I really appreciate it. I hope you had a fantastic week, and we will talk soon.